In the previous sections, you learned what market value is and how appraisers develop a supported opinion of value through a structured process. You also saw that appraisals often rely on three classic approaches to value: the sales comparison approach, the cost approach, and the income approach. In this section, we focus deeply on the one you will encounter most often in everyday residential practice: the sales comparison approach. This is also the foundation of the broker's comparative market analysis that you, as a salesperson, will use regularly with buyers and sellers. The sales comparison approach, sometimes called the market data approach, is built on a simple but powerful idea. Most buyers will not pay more for a property than it would cost them to buy another similar property in the same market. In other words, they can always substitute. This principle of substitution, combined with the principle of contribution, guides the appraiser's adjustments. Contribution asks how much certain property features, like an extra bathroom, a pool, a better view, or a larger lot, actually add to value in the eyes of typical buyers. Because the sales comparison approach uses recent sales data and focuses on the subject's specific features compared with competing properties, it is closely aligned with current market realities. That is why it is the preferred method for valuing 1 to 4 unit residential properties in active markets, and why it feels so familiar to real estate professionals who work with comparable sales every day. At the same time, the approach has limitations. Every property is unique, so no comparable is ever a perfect match. For special purpose properties, such as churches, schools, or highly customized buildings, there may be very few truly comparable sales. In addition, the approach works best when the market is active. If sale activity is slow or prices are fluctuating rapidly, it becomes harder to find recent, reliable sales, and to be confident that yesterday's prices still reflect today's values. Overview of the sales comparison approach. The sales comparison approach involves 3 main stages. First, the appraiser identifies appropriate comparable sales. Second, the appraiser compares each comparable to the subject property and makes adjustments for differences. Third, after all comparables are adjusted, the appraiser evaluates which adjusted indications are most reliable and reconciles them into a final value opinion for the subject property. The key idea is that the subject's value is inferred from actual market behavior. The comparable properties have already been tested in the marketplace. Buyers have made offers, negotiations have occurred, and final sale prices are recorded. By analyzing why those properties sold for what they did, and then adjusting for differences, the appraiser estimates what the subject would sell for under similar conditions. Identifying comparables. A comparable, often called a comp, is a property that has recently sold and is similar enough to the subject that the sale price can be used as a starting point to estimate the subject's value. To qualify as a good comparable, a property generally needs to resemble the subject in size, design, utility, and location, and must have sold recently in an arm's length transaction. Similarity means that the comparable should have roughly the same number of bedrooms and baths, similar square footage, a similar style or design, and similar functional utility. Location matters because even 2 similar homes may have different values if one is on a busy road and the other is on a quiet cul-de-sac. Recency is important because markets change. Appraisers typically prefer sales within the past 6 months, or even more recent in fast-moving markets. A 3-year-old sale might not reflect current prices if the market has appreciated or declined significantly. An arm's-length transaction is one where the buyer and seller are unrelated, well-informed, and acting in their own best interests. A sale between a father and daughter, or between business partners, may occur at a price that does not reflect market value. Appraisers are cautious with non-arm's length or distressed sales. Appraisers often look at 3 to 6 comparables and usually include at least 3 in the report. They draw on multiple sources for sales data, including the local multiple listing service, county tax and deed records, and title company data. In lending situations, secondary market guidelines, such as Fannie Mae's standards, may impose additional rules on how far away in distance or time a comparable can be from the subject, or how different it can be in size or design. Adjusting comparables. Once suitable comparables are chosen, the appraiser adjusts their sale prices to account for differences between each comparable and the subject. A crucial rule guides this step. You never adjust the subject property, only the comparables. The subject's value is unknown. The comparable's sale prices are known. So the process begins with the actual sale price of each comparable, and then the appraiser adds or subtracts dollar amounts to reflect how that comparable differs from the subject. If the comparable is superior to the subject in some feature, the appraiser subtracts value from the comparable's sale price to neutralize its advantage. For example, if the comparable has a pool and the subject does not, the appraiser may subtract an amount estimated to be the pool's contribution to value in that market. If the pool contributes approximately $6,000 to market value, that dollar amount is deducted from the comparable's sale price. If the comparable is inferior to the subject in some feature, the appraiser adds value to the comparable to bring it up to the subject's level. For example, if the subject has an extra bathroom and the comparable does not, the appraiser might add an amount that reflects the value of that additional bathroom in the local market. These adjustments are not based on how much the owner spent on improvements. They are based on contribution, which looks at how much those features actually change what buyers are willing to pay. A pool that costs $30,000 to install might only contribute $15,000 in a particular neighborhood. Appraisers make adjustments in several broad categories. Time of sale is one, because markets appreciate or decline. If a comparable sold 6 months ago and prices have risen since, the appraiser may adjust its price upward. Location is another. If a comparable is in a slightly more desirable neighborhood, a downward adjustment might be necessary. Physical characteristics are also critical. The appraiser may adjust for lot size, square footage, number of bedrooms and baths, age, condition, quality of construction, design appeal, parking, and amenities like pools, fireplaces, or views. Finally, transaction characteristics may require adjustment. Special financing, seller concessions, or unusual sale terms may artificially increase or decrease the recorded sale price. After all the relevant differences are analyzed, each comparable ends up with an adjusted sale price that represents what it would have sold for if it had been identical to the subject in all major respects. These adjusted prices are then used to form a value range for the subject. Weighting comparables and reconciling indications. When all selected comparables have been adjusted, the appraiser has several adjusted sale price indications. They rarely all match exactly. Instead, they form a range of values. The appraiser's final task within the sales comparison approach is to decide which indications are the most reliable and to reconcile them into a single value opinion or a narrow range. 3 quantitative guidelines help the appraiser decide how much weight to give each comparable. First, the total number of adjustments is important. A comparable that requires only a few small adjustments is usually more similar to the subject and therefore more reliable. If a comparable requires many adjustments, the margin of error grows. By the time 6 or 7 significant adjustments are made, confidence in that comparable as an indicator declines. Second, the size of individual adjustments matters. A comparable that needs very large dollar adjustments for 1 or 2 items may be less reliable because those big adjustments are more likely to be imprecise. Smaller adjustments suggest that the property is naturally closer to the subject. Third, the total net adjustment as a percentage of the sale price is also considered. If the net effect of all adjustments is very small, the comparable is likely a strong indicator. If the net adjustment is very large, the comparable may be less reliable. For example, if a home sold for $100,000 and the net adjustments change its indicated value to about $121,000. That is a 21% change. Many lending guidelines, such as those of Fannie Mae, become cautious when total net adjustments exceed around 15% of the sale price. The appraiser then looks at all comparables together. A comparable with very few, small, offsetting adjustments may be considered the best indicator of value. Another with moderate but acceptable adjustments might be the second best. A comparable that needed many or large adjustments may be considered a weaker indicator or even unsuitable. The final value opinion will often be near the adjusted values of the most reliable comparables. A narrative example of adjustments. Imagine a subject property with 8 rooms, 3 bedrooms, 2 baths, 2,000 square feet of living area, a 2-car attached garage, and good landscaping in a typical neighborhood. Comparable A sold last month for $100,000. It has 2 bedrooms, 1 bath, 7 rooms total, and 1,900 square feet. It lacks some of the subject's features and is slightly inferior in design appeal. The appraiser adds several small amounts to its sale price for the extra bedroom, the additional bath, the extra living area, and slightly better design. After all additions, the adjusted value of comparable A might be around $104,500. Comparable B sold for $120,000. It is larger, newer, better constructed, and in slightly better condition, with more rooms and baths than the subject. The appraiser deducts amounts for each of these superior aspects. After multiple downward adjustments, the adjusted value might drop significantly, perhaps to around $102,600. Comparable C sold for $115,000 and is extremely similar to the subject in most respects. It is a bit older but has a slightly larger lot, so one adjustment adds value and the other subtracts value. These offset each other, leaving the adjusted value equal to the original sale price of $115,000. Comparable D sold for $109,000 in a slightly more desirable neighborhood, but is otherwise somewhat inferior in condition and construction quality. The appraiser subtracts for the better location, but adds for inferior features, resulting in an adjusted value close to $112,500. Looking at these adjusted indications together, the appraiser notes that comparable C required the fewest and smallest adjustments, making it the strongest indicator. Comparable D also required modest net adjustments, so it is the second strongest. Comparable A is reasonable but required more adjustments. Comparable B required many adjustments and a large net change from its original sale price, making it the weakest indicator. Taking all this into account, the appraiser might conclude that the subject's market value is approximately $112,000. Brokers Comparative Market Analysis, CMA. As a real estate salesperson, you will not typically produce formal appraisals, but you will frequently create comparative market analyses, or CMAs. A CMA is essentially a scaled-down version of the sales comparison approach. You select recent comparable sales, active listings, and sometimes pending sales to estimate a likely listing range for your seller or a realistic offer range for your buyer. Like an appraiser, you adjust for major differences and look for patterns in the data. However, there are important differences between a CMA and an appraisal. A CMA is less comprehensive. It may not involve a full investigation of market conditions, neighborhood trends, or all physical details of the comparables. It is also not neutral. As the listing or buyer's agent, you have a direct interest in the outcome and may be influenced, consciously or unconsciously, by the desire to obtain the listing or close the sale. Because of this, a CMA should never be presented as an appraisal. It is a professional estimate and a valuable tool, but it does not carry the same regulatory or professional weight as a licensed appraiser's opinion. Being clear with clients about what a CMA is and what it is not helps you manage expectations and maintain credibility. Review summary. In this section, You learned that the sales comparison approach is the most widely used method for estimating market value of typical residential properties and is also the core of the broker's comparative market analysis. It is grounded in the principles of substitution and contribution. Buyers compare available alternatives and assign value to specific features based on how much those features contribute to their willingness to pay. You learned that good comparables must be similar in key features, must have sold recently, and should reflect arm's length transactions. The appraiser adjusts the sale prices of comparables, never the subject, to account for differences in time of sale, location, physical characteristics, and transaction terms. You also learned how appraisers evaluate the reliability of each comparable using the number of adjustments, the size of adjustments, and the total net adjustment percentage. Finally, you examined how a broker's CMA mirrors the sales comparison approach, but is less formal, less comprehensive, and not neutral. As a salesperson, understanding this method allows you to talk confidently with appraisers, explain appraisal results to clients, and prepare more accurate CMAs. Discussion. Why does the appraiser adjust the comparable sale price instead of adjusting the subject? Answer. Because the comparable sale price is known, while the subject's value is not. The purpose of the sales comparison approach is to infer the subject's value from actual market transactions. Adjusting the known sale prices of comparables for differences yields an indication of what the subject would likely sell for if it were exposed to the same market conditions. What makes a comparable a strong indicator of value? Answer. A strong comparable is one that is very similar to the subject, requires relatively few adjustments, has small individual adjustments, and has a low total net adjustment as a percentage of its sale price. These factors suggest less guessing and a smaller margin of error, making the adjusted price more reliable. Why is it risky to use a distressed or non-arm's length sale as a comparable? Answer. Distressed or non-arm's length sales may not reflect true market value because one or both parties may not be acting under fair, balanced conditions. A family transfer, a foreclosure sale, or a transaction under severe pressure might occur at a price much higher or lower than what a typical, well-informed buyer and seller would agree to. How is a comparative market analysis similar to and different from an appraisal answer? A CMA is similar in that it uses recent comparable sales and applies the same basic logic of comparing and adjusting for differences. It is different because it is less comprehensive, not regulated as an appraisal, and prepared by a party who often has a direct interest in the outcome. An appraisal is a formal, neutral opinion of value performed by a licensed appraiser under professional standards. Closing remarks. The sales comparison approach brings market value down to earth by anchoring it in real closed sales. This is the language that buyers, sellers, and agents naturally speak when they talk about comps. By understanding how appraisers select comparables, make adjustments, and weigh indications, you sharpen your ability to price listings accurately, defend your asking prices, and educate buyers about realistic offers. Mastery of this approach not only makes your CMAS more credible, but also prepares you to communicate more effectively with lenders, appraisers, and clients in every kind of market.